everyone, and welcome to day 3 of SMG Prep Week. So it's been an exciting journey so far, and we want to thank you for the energy and engagement that you brought to each and every single session. So on day 1, we explored stocks and exchange traded funds, or ETFs. And yesterday, we took a closer look at mutual funds. These are two of the most dynamic ways that students can start to see how markets work. Now, today, we'll turn our focus to bonds. And bonds are often called the steady side of investing because it offers a different perspective on risk, return, and long-term financial planning. So by understanding bonds, you'll be able to help your students see the full picture of diversification and why balance matters in an investment portfolio. So by the end of today's session, our hope is that you'll feel confident not only in explaining bonds, but also in connecting them to the decisions that students will make inside the stock market game. So thank you for being a part of this 3-day learning experience. So let's make our final session the strongest one yet. So joining us again today is Kim Siegel, a financial advisor, part of Edward Jones's wealth management team. We're so grateful to have Kim back for another session to round out this day 3 session where we're talking about bonds. So I'll have Kim introduce herself and tell us a little bit more before we get started. Welcome, Kim.
Thank you, Sarah. I am excited to be back with everyone today. I hope you had a great day yesterday learning about mutual funds. Bonds are actually near and dear to my heart. I have been a financial advisor and now a certified financial planner with Edward Jones for 3.5 years. But for the first 20 years of my career, I specialized in municipal bonds, which is a specific type of bond, and I sold those to institutional investors. So bonds are a special part of my heart. A lot of people get intimidated by them because they're different and they can be hard to understand, but we're going to make it easy and simple for you today. As a reminder, I became a financial advisor because I have a passion for finance and investing, and I really enjoy helping people meet their goals. That's one of the reasons I'm here with you today, to help you meet that goal of becoming educated investors and the best teachers you can to the students in the game that are going to be hopefully building brilliant portfolios. So thank you for joining us today. And if we can go to the first slide, I want to talk to you just a little bit about the goal process. We talked about this on Monday, but through my experience as an advisor, I've worked with many investors and their goals vary, but our process remains the same. When we work with someone, we need to find out what's most important. The first step is what's important to the individual so that we can make sure their investments help them reach their goal. Number 2, and 3, we look at what they're doing, what they've done so far, where they want to go. Then we put that together in a plan to see how can we help them get there. And then most importantly, every year we need to review that plan and make sure it's still on track for their goals. We can go to the next slide, Sarah. I want to talk about bonds. Bonds are a type of fixed income investment. And when we say fixed income, it means they have a specific coupon or interest rate that's tied to them, and that rate is fixed. So fixed income securities like bonds, they are where you're going to lend your money in exchange for regular interest payments and the return of your principal investment at maturity. Because bonds have those regular interest payments, they aren't subject to the same volatility as stocks, exchange traded funds, or mutual funds. What I mean by that is your stocks, we talked about, we want to buy them low and they may grow high, or they may pay dividends, but we're expecting those to grow in value. Your bond is set at that fixed income rate. It has that fixed coupon or interest rate. And so that fixed rate helps keep things more stable over time. If we could go to the next page, Sarah, I want to talk about the different kinds of bonds. Municipal bonds are the ones I specialized in, and those are issued by state and local governments to fund public projects for buildings or improvements for things like schools, highways, sewers, airports, and hospitals. Often a municipal bond is going to be issued by the city or a special authority of the city, community, town that's created specifically for that purpose. Municipal bonds are going to, you're loaning your money to the city or town so that they can make those improvements. They collect their taxes and then they pay your interest, that coupon, out twice a year to you. Similarly, a corporate bond is a type of bond that's issued by a corporation. So just like we talked about being able to buy stocks of a company can also loan money by bonds, which would be they would, you would loan them your money in the form of that bond, and they would give you a set interest rate that they would pay you over time. The third type is US Treasury bonds. These are essentially a loan that you lend the federal government. So they are paid back with the full faith and credit of the US government, and they are considered the most secure of the bonds because they have the payback of the government. So those are our three main types of bonds. If you could go to the next page, yep, you're already there. I want to talk about how they work. This part can get a little confusing. So US government, let's say they're going to issue a treasury note. The fixed coupon that they're going to put on it when they issue it, which is based on the market rates, let's say in this example is a 4.5% coupon, and its final maturity is 10 years. What that means is you are loaning them the money for 10 years. So during this 10-year period, in this example, you're giving them a $10,000 loan to buy a $10,000 bond. You loan them the $10,000 twice a year on a semi-annual payment. They are going to send you a total of that 4.5% of the $10,000, which is $450. So twice a year, you're going to get a check in the mail for $225, $250, $225. At the end of those 10 years, you're going to go back and they're going to give you your initial $10,000 back. Over time, you've also made $4,500 in those interest payments. Why bonds, right? Aside from just predictable returns from that fixed coupon, fixed income investments have other advantages. So we consider them an excellent way to diversify your portfolio to mitigate risk. We know that things that we put in the equity market, stocks, mutual funds, exchange traded funds that are stock focused, you don't have that set interest rate, and so you're subject to the market. Fixed income investments with that set rate, you're diversifying that risk. Then many types of fixed income investments are liquid, meaning you can buy and sell them anytime. So let's say you bought that 10-year treasury bond, and after 5 years, you decided you wanted to get your money back. You could then sell that bond back on the market for whatever value it was that day. So they're liquid. And then fixed income investments, they provide regular returns during recessions or economic downturns. So what I mean by that is if you have a portion of your portfolio in bonds, let's say you have a 50-50 portfolio, 50% in stock-based products and 50% in bonds. If there is a market downturn where stocks take a downturn, then your bonds are still going to be paying that same interest rate that they have been before the market went down. So the regular returns during recessions or economic downturns can help just provide that stability. We could go to the next slide. I just want to review the overall strategy behind, okay, remember, the first thing is we have to figure out that why. The why sets our strategy. And our investment strategy is going to be determined by our goal, our long-term goal, our investment time frame, and how comfortable we are with the risk in the market. That's going to help us determine how much risk we should be taking on, how much should be in stocks and bonds. Rule number 2 is stick with quality. We discussed this, but we want to find investments whose management we feel comfortable with, who products we feel are successful, and who have the ability to continue growing over time. Rule number 3, we want to make sure we diversify. And when we talk about diversifying, we want to diversify within different types of products like stocks, bonds, exchange traded funds, and mutual funds. We also want to diversify between maybe different types of the market and different risk profiles. Invest for the long term. We want to make sure that once we set that strategy, we keep that strategy and we don't let things like the market change our plan, which brings us to number 5, which is focus on what you can control. You can't control the economy, but you can control your spending and saving habits. You can't control the stock market, but you can control the way you respond when it drops. What kind of questions do we have about bonds or this portion of the segment?
Perfect. We actually have a few questions for you, Kim. So I'll let you jump in. So some of the questions, one includes, in general, do you look for bonds as stable long-term income? And if so, are bonds even worth purchasing for the short term?
It's a great question. We actually look at bonds in 3 different time frames: short term, intermediate, and long term. Our short term bonds are actually going to be things that are going to meet those short term goals, maybe 3 years and in. Our intermediate term bonds may be between that like 3 and 7 to 10 year range. And then those long term bonds may be between 10, 15 year and longer. Determining where you fall on that category of when you put that final maturity is going to depend on a couple different things. One is going to be when you want to spend that money, when you need to get it back. And 2 is also going to be interest rates. Thank you. So when interest rates are higher, like they have been, we may be telling people to extend their duration or go out a little bit longer with those bonds to lock in that higher coupon while it's higher, that higher interest rate. When bond yields are low, you may want to go shorter. It kind of depends on what's going on in the interest rate, but also when you want to spend it. So certificates of deposit or CDs, those are a type of short-term bond. And we do a lot of short-term bonds. That is a safe place to put your money for a short-term goal that's going to have that regular interest payment. So they can be used for both. That's a good question.
It's a great question. And there was an additional follow-up in that question regarding specifically utilizing bonds within the stock market game. If you are participating in perhaps a semester-long session or a year-long session, how do you see the development of that bond? So Kim touched on maturity dates, which is when that will pay out. And you will have the opportunity to see the maturity dates of the bonds that you are potentially interested in throughout the stock market game. So those that are participating in perhaps a semester-long session or a year-long session tend to look for bonds that have a maturity date that falls within their game session window. And we're going to go over that shortly. We have another question, Kim. Someone asked, do bonds always get lower returns than stocks in general?
In general, yes. In general, we would say that things with a fixed income, a fixed coupon, those are often going to be issued at current interest rates. And so those they aren't really built to keep pace with inflation. They're going to be right around where current interest rates are. So in general, the stock markets should continue climbing. We talked about how in general it's gone on to higher levels every time. So far, it just depends on how long it takes. Now, if the market's in a big downturn, then you might earn a higher return from your bonds that year. But over time, we would expect that the bonds won't necessarily outpace inflation and the stock market would.
Great, thank you for that. And then I think it might be important to note someone also made more of a response, but I'm going to kind of turn it into a question more so for everyone's benefit. In terms of um, bonds that have a lower grade or a lower credit rating, do they tend to earn higher returns over a short period of time than those with a higher grade?
So similarly to stocks, the more risk you're willing to take on, the more reward you can get. And when a city or a corporation wants to issue a bond, one of the things that happened is a credit agency is going to look at their credit and see, okay, what's the ability for them to pay this back? Some people might not want to go through that process if it's a small issue, so they might even go non-rated if they know people will just know their name, or they might get a low rating if their business is risky. In those situations, that would be what you're talking about, a lower quality bond, meaning they don't have as much a guaranteed ability to pay it back. That's going to carry more risk and will get a higher yield, but there you run into the risk that they can't pay back at all and it goes into default. That's the risk of bonds, that the payer of the bond can't pay it back and it goes into default. It's very rare, especially in municipal bonds. It does happen occasionally in corporate bonds if a corporation would go bankrupt. But yes, you will get more reward for that more risk on the short term.
Thanks so much, Kim, for all of your great answers to these questions. I think we've reached the end of the questions for now, but I encourage all of our participants to keep the questions coming as we go throughout. Kim is able to join us throughout the duration of the program. So if you're able to, if a question comes up later as we're going along, please don't hesitate to add them to the chat. But thank you so much, Kim, for joining us this afternoon. And thanks to all of our attendees for all of those great questions. It's always a great way to hear your curiosity and your perspectives come through. So before we jump into the next session, let's hit pause for just a quick bond refresher. So we'll go over the basics of what bonds are, how they work, and why they matter, just to make sure we're all on the same page. Then we'll dig a little bit deeper and explore some of the details that bring bonds to life for students within the stock market game. So companies, federal, state, and local governments issue bonds to raise money, finance new projects, maintain operations, or refinance debt. So as Kim noted, a bond is essentially a loan that's made by an issuer or the borrower to an investor who essentially serves as the lender. The par or face value is the issued loan amount. At that point, the issuer pays a coupon or an interest payment on the face or par value to that investor. And the coupon rate or the interest rate on the bond is what determines the amount of that coupon payment. So we noted the three different types of bonds, and most bonds are issued at $100 or $1,000 increments and mature at face or par value. Corporate bonds typically have a face value of about $1,000. Municipal bonds typically have a face value of about $5,000, and most government bonds about $10,000. And issuers pay coupons to the investor until the bond matures or reaches its end date. And the face or par value is then paid back in full. So the maturity date is the day that the bond issuer must pay the bond's face or par value back to the lender or the investor. So upon maturity, there are no more coupon payments left and the bond ceases to exist. Now, bond prices, like stock prices, depend on factors including overall performance of bonds as an asset class in the current marketplace, the credit quality of the issuer, the length of time until it matures, and the bond's coupon rate compared to the current market interest rates. So generally, if a bond's coupon rate is higher than current market interest rates, its price will be higher than the face value and also vice versa. So how do you invest in bonds? So there are typically two different direct ways. So you can buy individual bonds directly from the organization that issued them or through a broker. which tends to be a preferred option when choosing to invest in a specific type of bond. Now, the other alternative is a bond fund. So these are mutual funds that invest in a variety of bonds. Now, the specific bonds are constantly changing within a bond fund based on market conditions and investor demands. So they don't really have a specified maturity date. But this flexibility can mean more convenience and less risk, making them an ideal choice when you don't want to invest too much money or you want more of a hands-off approach. So we're going to put this new knowledge into practice and trade a bond within the stock market game portfolio. So we are at stockmarketgame.org and we are going to log in to access our stock market game portfolio. As you remember, your usernames and passwords are case sensitive and must include all characters, including underscores. You'll know that it is a portfolio login because the last letters should start with a Z, Z, or an A. Once we log in, we'll be brought to our stock market game portfolio, and related to any type of trade that we are attempting to make, we can do that via the trade tab and select and enter a trade. You'll see the three different asset types that are available within the stock market game: stock, mutual fund, and bond trade. We're going to select bond trade for this transaction. As a reminder, if you're thinking about ETFs, those trade like stocks. If you are interested in a bond fund, you would select a mutual fund. But thinking about the type of bond that you are interested in, you can actually search for them directly within the stock market games portfolio section. You don't necessarily have to go to a separate place. And if you're thinking about where to get started, I'll show you a couple of different ways to do that. So you would click search for bond, and then it'll populate a separate section that allows you to search for corporate bonds, municipal bonds, or government bonds. When you're searching for corporate bonds, you can simply put the name of any company that you can think about. Typically, a great place to start with our students, if they've already begun trading stocks in any capacity, they can think about companies that already exist within their stock profile, because there are a number of companies that are publicly traded that also have bonds. So for example, if your students invested in, let's say Disney, for example, they have a Disney stock and they would like to see if Disney Corporation has a bond, they can put in Disney and select search for corporate bonds. And then they will see that Disney has a number of bonds that are available and tradable. When you select this option, you'll see a set of symbols here. Every single bond has what we call CUSIP numbers. And CUSIP numbers are a unique set of credentials that help to identify a bond. Within the stock market game specifically, the two letters in the beginning of that CUSIP number will relate to the type of bond that it is. For corporate bonds, you'll see CO. For treasury bonds, you will see TR. And for municipal bonds, you will see MU. Then you'll see the unique CUSIP ID that is separate from the type of bond. You'll see the type of the name of that particular bond, its last price, its coupon rate, the next payment date. So you'll be able to see that right up front. And I think that can be helpful for that question that we received earlier regarding, how do you really see payments and see things develop within your game session window? So you may choose to look at, well, when's the next payment date? And you might select a bond that falls within the payment date of when your game session is. You can also adjust these tabs if you wanted to see the payment date ranked in order or the maturity date ranked in order. You can also do the same for the type of rating. So let's say I'm interested in investing in Walt Disney Company. I'm able to see the full information of Disney, including the date that it was issued, the date it will mature, the first coupon date that was available, the previous payment date, and the next payment date, which I'm seeing is September 15th, 2025, having an interest rate of 6.55%. and I'm seeing the price of that particular one and as well as its rating. So after looking through this, if this is a corporate bond that I'm interested in trading, I can simply click trade, and it adds the CUSIP code directly into my trade tab. And then for face value, so bonds trade in dollar values as opposed to share values. So whereas mutual funds and stocks and ETFs, when entering those trades, you are putting a numerical value that equals every single share. For bonds, you're going to put in a numerical value, either at increments of $100 or $1,000. So I'm going to start at $1,000. This will be a buy transaction, and I'll preview that bond trade. This will provide an overview of what that order will look like, including what my buying power will be after that transaction is placed. I will enter my password and then simply click confirm transaction. Now, bonds, just like mutual funds, will be priced at the end of the day. So you'll receive the confirmation for that at the end of the day. Will update within your portfolio. You can find all of your bond orders as they are made within your pending orders. Now we'll go through how to search for a municipal bond. So municipal bonds tend to function based on state. So for your students, a good starting point is either the state in which they are located and to see which types of bonds are available in their location. If you want to work with them to discuss not only what is available within their particular state, but what is it funding? What if they're looking to you as the lender, but they're looking for to borrow this money from you? For what? What does it serve? What is it going towards? And doing some initial research for that can also help to provide some color, not only into their communities and their states, but also like where the value of that bond. So if I were interested in bonds in Colorado, I can select Colorado and then search municipal bonds, and it'll allow me to see all of the available bonds that are available in my state of Colorado or my interested state of Colorado. You can also click on any of the bonds to receive additional information on what that bond means and a full description. You also have the opportunity to see the last price, the coupon date, and of course, those next payment dates for these as well. The same thing goes for government bonds. You can just simply select government bonds to see all of the different variables that are available for United States Treasury bonds. Now, these are bonds specifically found in the New York Stock Exchange and NASDAQ. You'll know that it's a treasury bond based on the TR that is found in front of the CUSIP code, and you can have the same information that's available. If you would like to stay within a specific price point, you can do that as well and adjust the tabs accordingly to see what is available. So in trying to, and with all of them, you can always just select them, see the overarching information, and then click trade to enter it directly. If you already know the details, or perhaps your student has encountered a bond that they are already interested in investing in, there is no need to go through the search portion. They can simply enter in the CUSIP code, make sure that it has the header in front of the type of bond that it is, and enter it directly. If they're not sure and they receive a CUSIP code that they're not really sure about, and you want to make sure, they can select validate bond and it'll validate it for them to make sure that it's correct. I'm going to pause here to address any questions. Great question in terms of how do you identify a good bond or a risky bond? Right within the system, and I'll actually go back here. I'm searching for them. You can go back to government bonds to use that one as an example. Let me go back to Disney. Do a corporate bond example. You'll notice that every bond receives a grade rating, and you're able to see directly the type of grade that they go into. So it varies from A to AAA, which is kind of like an A+, And actually, Kim, if you're still here, it might be helpful for you to touch on how and why do bonds receive grades and ratings?
Yeah. So when a corporation or a city wants to issue that bond, a rating agency, so S&P is one of them, and Moody's is another. They will go and analyze the financials of that corporation or the city, the town, the library district, whatever's issuing that bond, and they will analyze how likely they are to be able to make all of their payments back on the entire issue of bonds. They will then, after that analyzing, come up with a rating. The ratings go from triple A's, or like the three A's for S&P rating, or double A three for Moody's. Those are the highest ratings. Then so it goes triple A, double A, single A. Then you go down to triple B, double B, single B. So the rating is based on whoever's issuing the bond. These are all issued by Walt Disney Company, so they all have the same credit rating. The difference in risk in these would be only the maturity. The sooner ones would definitely be paid back faster than the later ones. Does that help a little bit?
Absolutely. Thanks so much, Kim. So I see some additional questions, and some are twofold. So I'm going to join them together. So there's a question of, are there particular strategies students use when investing in bonds during the short semester or the year-long session, like looking at upcoming interest payment dates or maturity dates? And that's absolutely right. So most students, when they're looking at their particular game window, whether it's participating within the entire semester or the academic year, they'll look at this next payment date. And I'll organize this in order of next payment date. So for example, if I'm interested in investing in Disney in any capacity, and maybe I wanted to get a bit more specific there, and I'm participating in a fall game session that runs from, and I'll even go beyond the September 15th one from Disney Walt Company. And let's say my session begins September 20th, but it's running all the way through December. I would be interested, but I want to see a payment from my bond during my game session to see how that would manifest and develop within my portfolio. I'd look at opportunities where those next payment dates fall within my timeline. So perhaps I may explore the Disney, this one here that has a payment date on October 1st, another option for October 8th. I'm going to explore the one that's on October 30th. I, of course, want to see what type of rating. So the timing isn't the only thing that I'd be considering. But yeah, so you can look at the next payment date so you can see when it's going to at least see some type of payment within their portfolio. So they just select ones that are found within their specific game session. There's another question regarding what is the last price mean for each bond? So the last price within the stock market game, whenever you see that, and that also accounts for the last mutual fund price or the last SMG price. That is the last price that was paid for that particular security, specifically within the stock market game. That's not necessarily the closing price or the last price for that stock, bond, or mutual fund in general. It gives you an idea of what that price was for the last stock market game participant that bought that particular security. This helps kind of just put a comparison into like where that, an additional comparison into where that security was or currently is at that particular time that you're ready to trade it.
Sarah, I can handle that last question from Kim if you'd like.
Absolutely.
Okay, so
And for those who may just be listening in as opposed to being able to view, I'll read the question out loud for the entire group. And the question is, how should an investor interpret the last price when compared to the coupon rate?
so the coupon rate when an issuer is going to issue a bond, the interest rate is set when they issue the bond. So they're going to write a bond deal. Disney's going to come and write one of these bond deals, and it's going to have a lot of different maturities for one big deal. When they write that deal, each maturity is going to have that fixed coupon or interest rate that they set when it's issued. Let's use a 5% interest rate for an example. If it's issued at 5%, that's the coupon, that's the yield, that's how much they're going to get annually. Well, if interest rates drop down and say interest rates in the market have now dropped to a 4, they're lower. So if that same company was going to issue those same bonds, they could only get a 4% for them. That means your 5% coupon bond is worth more money. People will come and pay you more than you paid for it so they can get that 5% coupon interest payment each year. So that makes the price go up higher. So the last price will go higher if interest rates have come down since you purchased it. On the other end, if you originally bought a 4 and now interest rates are at a 7, people don't want to buy your 4% coupon when they could go buy a brand new one at 7. So you may see bonds that are at a 98 or a 97. They're actually below that price. That's the correlation between that coupon and that last price, where interest rates are now compared to the interest rate that's on that bond.
Absolutely. Thanks so much, Kim. That was perfect. But while selecting bonds, do students need to understand what the bond will be used for to identify the risk, especially within government or municipalities?
And that is an excellent question. So yes, they do. When it comes to what the bond will be used for, on a corporate bond, you don't get that choice. The corporation is just issuing, they're borrowing money for whatever they need. But when you come to a municipal bond, they will have different needs. So, for example, I mentioned a library district earlier. A library district could issue a bond to improve the library system. A city could issue a bond to improve the roads or to build a firehouse. Things that are issued as that are going to be a direct payment of city taxes without new taxes coming in are called a general obligation. They're paid by just general city tax revenues, and they are a full obligation of the city, the issuer there. When it comes to specific municipal project bonds, like maybe for an airport or for a hospital, those are going to have a higher interest rate because they're more risky. They're based on the revenues of that project. They're called a revenue bond. So when it comes to municipal bonds, yes, what they're being used for and how the taxes are collected, whether or not it's a general obligation tax or it's a special revenue coming from that project, determines some of the risk involved there. Oh, Sarah, you're still muted.
Thanks so much for that. And I think those are the end of the bond specific questions, but please don't hesitate to continue asking them. We welcome any of your questions. We want to answer them and provide as much clarity and color as possible. So let's get into some next steps before we transition into some of those more stock market game and program specific questions. Just want to round us out and thank all of you for joining us for Stock Market Game Prep Week. So over the past 3 days, we've explored stocks, mutual funds, and bonds, building not only on your own knowledge of these key investment concepts, but also strategies for bringing them to life with your students. So our hope is that you leave this series feeling more confident, better equipped, and excited to guide your students as they step into the world of investing through Stock Market Game. So the work that you guys do as advisors is so incredibly important because by engaging students with these tools, you're helping them build financial skills that will last a lifetime. So thank you again for your time, your energy, and your commitment to financial education. So I cannot wait to see the impact both you and your students will make, and best of luck as you launch your Stock Market Game experience.